really delivered against their benchmarks. And, if I'm totally to be fair, we were a little bit more conservative the first half of the year because of those higher valuations. And we were also in the camp that we thought we'd see more of a slowdown than we saw. So I don't think we were alone in expecting those 525, 550 basis points of rate hikes since March of 2022 to begin to bite in the economy. So we were really, I think, a little bit surprised with the resiliency, and then we can go into sort of details on why that is. But the bottom line is, these portfolios are structured to have multiple sources of value added. So even if the asset allocation isn't perfect, we have other levers to drive value. And importantly, I think we have some really strong managers. We were really emphasizing that high active share in portfolios, and fortunately that worked to our advantage. Coming into this year, kind of the similar setup. We expect that we will see slower growth, but we've been here before. Again, to be calling a recession, we have a couple of, we have some slides in the package that can speak to it. But if you look at the inverted yield curve, if you look at lead indicators, a lot of those are flashing caution. But again, we've seen real resiliency, particularly where it comes to the U.S. When it comes to the U.S., we're growing above trend. Again, profit expectations are elevated, and we expect that those need to be marked down over the course of the year. And again, starting with really high valuations, to your point, we've just taken out a high in the S&P. And so the setup isn't wonderful. But to the extent that we stay resilient, maybe we continue to climb this wall of worry. And I think it's really important to continue to have some risk in the portfolio, and we do. Our asset mix is much more balanced. We are taking some interesting intra asset class, sort of tilts where we're seeing a little bit more value in what is a largely, a fairly picked over market, in the sense that 7 stocks are really driving the returns on the S&P 500. I mean, there's more breadth in other markets, but we can probably get into that as we go along. So constructive, I think 60-40 is the right approach. We're seeing a lot more value in that 40 component, i.e. bonds are offering more value than they had clearly going into 22, but even, the recent sell-off that we've seen. So I still think balanced and multi-asset portfolios can serve clients well in this environment.
Perfect. So keeping on that same sort of macro lens of, you mentioned the recession, and then feel free, if you do want to share anything, share your screen, go to wherever you need to go. But talking about the recession, because I think that's probably, the word that you're hearing over and over and over, right? Start of last year, it was these higher rate hikes are going to bring the recession. And then we waited, and then we waited, and then we waited. So fast forward now to 2024, and that's still, there's 2 camps, right? Those higher interest rates are eventually, they work on a lag. They're eventually going to get us. They're going to get us down to, or we're going to get that recession. So just talk us through, you hear at least on the US side, it's the recession conversation, or it's the soft landing. Like, we're going to avoid this. Inflation's going to come down. We're going to slow growth, but then we're just going to kind of move along and we're going to avoid that recession. So that's the one side of it. But then also talk us through Canada, because I think us being Canadians, right, it's important that there's so much talk about the US, but we understand that Canada is more susceptible given our interest rate structure. So how does that play a role? Do you see us sticking the landing, as they say? And then more importantly, how does that set up on a portfolio side of things? Does that affect how you're building portfolios? Oh, you're on mute, Steve. Yeah. There you go.
So we'll start with the U.S. And then we'll certainly transition to Canada. I think it's the right question. I mean, I think the odds of a no landing and a soft landing have clearly gone up. But I wouldn't close the door on a hard landing. And why do we think that is? I think, we did a lot of analysis on, the nature of the resiliency for the U.S. economy last year. And I think the key is that credit, which tends to be a lead indicator, isn't as important when there's no demand and people have, existing balances, from COVID transfers from the government, which has just been exceptional, obviously in Western markets, not so in China, as we're seeing. But I think that's really critical. So some of the lead indicators that we look at were eventually early or flashing a signal that really wasn't important last year when you again drew down those those government transfers. So I do think that things like credit collapsing wasn't a factor because people didn't need credit and could spend, whether it's businesses or governments, or sorry, businesses or households, and even governments get into the act. I mean, typically you don't see a 6-7% deficit when you're growing well above trend, as the U.S. economy was. So not only did the U.S. not have a recession last year, it didn't even have a slowdown. It accelerated over 2022. And to your point, I do think the lagged effects will catch up with the U.S. market, but it doesn't mean that it has to be a recession. But at some point, yes, those lagged effects, the higher interest rates as people roll over mortgages, less of an issue in the U.S., as you rightly pointed out, with the fixed rate, 30-year being the most common. So clearly, Canada, though, I think is very susceptible to this significant, interest rate policy increase that we've seen over the last year and a half. And indeed, we're starting to see some of those effects. What I've shared here, hopefully I've shared, is market expectations. So clearly, when we started, and I said 2022, obviously 2020, 2021 into 2022 there, that's March. That's when rates started heading up. They headed up, obviously, to a peak of 5.5%. I think over the last 3 months, we've seen with the Fed and the Powell pivot, again, not just in 2019, but they're kind of throwing the all clear on one of their mandates, which is obviously the inflation target. We've seen inflation come very quickly back towards target. I think our view was that would always happen. I think we may differ a little bit from the market in terms of how we get from 3 to 2, because I think wages and service inflation are a key component that's holding it up. I also think the disinflationary trend around goods is probably at its peak, i.e. we can't keep deflating. And I'll jump to a slide there that kind of highlights that. But this is the Fed interest rate policies. And I think this is where we push back a little bit, and then I'll definitely jump into Canada. The market is now pricing over 6 and even 7 cuts by the end of 2024. If that happens, it's not a soft landing, and it certainly isn't a no landing. The Fed will not be able to hit its inflation goal if inflation is not going to be back to target to enable this. So effectively, this tells me that it's more of a hard landing priced into futures markets, i.e., if the Fed's going to cut 6 or 7 times, the data in their eyes are likely to quickly unravel. Now, some of this has been the progress on inflation, right? So even if growth stays the same, if inflation comes down, the real policy rate is higher. So you would expect them to make a few cuts, right? 2 or 3 or even 4. But 6 or 7 really is more sinister, i.e. there's something else, going wrong in the U.S. economy that would precipitate that type of move. So then, yes, I mean, the market is very focused on interest rates, but I think at some point you have to ask the question, what are earnings do if the Fed is having to cut, 200 basis points? It suggests the economy is in much worse shape. So that's kind of what's in expectations on this slide. The other thing I just wanted to highlight is a couple of things that we look at. So you mentioned the lagged effect, right? And it could be different this time, but when you have a yield curve inversion, 6 of the last 6 times since 1970, you've had a recession. So again, not saying that 1 out of 7 times we may not have a recession, but you got to play the odds, right? So that's why we were a little bit more cautious last year. We're a little bit more cautious this year. The right-hand side of this slide also shows when lead indicators have this degree of slowdown, again, we've not avoided recession. Doesn't mean that we can't this time, but again, if you're playing the odds, you are positioning portfolios a little more defensively. And this is the last factor, and then I'll definitely answer your question, sorry, on the Canadian side, because that is a difference from the U.S. I think what's been sort of challenging is, again, if you're following lead indicators and credit lead indicators of credit activity, It's suggesting recession, but here's the difference. I think historically manufacturing has led services. So obviously we've seen weakness in manufacturing. Think about that blue line being above 50. That's when everyone was ordering multiple Pelotons and buying all their goods on Amazon, and they couldn't get any experiences. So goods were really, really booming, right? Services you couldn't access. There was a real service recession. Now it's the flip side of this. I think people have bought, all the goods that they can store or use during COVID, and are now back out to services and revenge travel and restaurants and things like that. So I do think this dichotomy between the goods and the services part of the economy is what's causing the overall economy not to nosedive, right? That service line hasn't followed that gold line hasn't followed that blue line. In fact, it's kind of diverged over the last year or so. So that's really behind, I think, the resiliency of the U.S. economy, and that's really important. How does that differ from Canada? If you look at Canada, we haven't had the resiliency, right? So if you look at quarterly GDP growth, as I'm showing here, obviously post-COVID boom in the fourth quarter of 2021, 2022 was above trend growth, but we saw some weakness in the fourth quarter. And then obviously more recently, we're seeing a lot more weakness. And I think this is where we're starting to see the impact of that significant rate tightening cycle in Canada versus US. Obviously, the big difference there is how mortgage costs in Canada affect Canadian households and impact their consumption. Mortgage interest costs have gone up a lot, obviously, as shorter term mortgages reset to higher interest rates, more tied to our overnight policy rate that is over 5% right now. So difference in the two economies. What does that mean for portfolio construction? I think bonds certainly in Canada offer a little bit. They should be trading through where the U.S. is. There are lower yields in Canada, but I think there's more economic weakness here. And there's more progress on inflation here than we would say on the U.S. side. On the U.S. side, though, obviously that resiliency is giving us pause for, is it different this time? So even though all the indicators are lining up for a recession, do we expect that will happen? And I think a big part of that, will sort of play out this year. Part of that will be the geopolitical and the election cycle. Obviously, the Democrats would like to get reelected. They'd love policy rates to go down. We wonder what pressure there might be on central banks. But, I do think if the government continues to spend and households, there isn't a lot of layoffs. We're starting to see layoffs now in the U.S. Anecdotally, and the unemployment rate has ticked up a little bit, but not really that concerning. It does favor more of a balanced approach. But regionally, there are opportunities. Outside the U.S., if we look at equity markets, but also fixed income markets, I think there's some good opportunities. I'll stop there.
Yeah, that makes a lot of sense. So keeping with, because you were just, partly kind of speaking to it here, but also the Fed funds rate graph, just staying with rate cuts for a minute, because that's where I think the market was a little bit nervous up until October of last year, until November 1st hits and the Fed says, look, maybe interest rate or maybe inflation is tame, maybe we're going to cut rates. And so that really fueled the end of the year rally in that rate cuts were coming. You had mentioned that what's priced in is about these 6 cuts in the US. If there are 6 cuts, that actually could mean a bad thing, because maybe that means we're going to a recession. But at the same time, when we think about markets, sometimes rate cuts means, well, risk on for equities because rates are going down. So there's this, back and forth that's happened there. And I think you said that maybe you're pushing back, maybe they don't have 6. So just talk us through, on the Canadian side, just to speak to that, I would love to know your thoughts on where you think they might cut, because, I got a variable rate mortgage and a lot of us would love to know when rates they think might come down. But just so on the US side, just that back and forth in terms of if you think it's not going to be 6 rate cuts, is this good or bad from a market perspective, right? From those cuts. And then on the Canada side, again, kind of the same question of, if we're in a little bit more of a recessionary environment, where do you see cuts happening in Canada? Are they happening before the US, ideally?
Okay, for me, that's the easier question. Maybe we may be wrong as always. It's
Yep.
possibility. I think the Bank of Canada probably leads here, because there's more economic weakness, a little bit more progress on inflation, and so that's and there's more resiliency on the U.S. side. They probably do both cut this year, but I would expect maybe the BOC leads slightly. I think, you're right. Interest rates, often dictate sort of future market performance. But I think we're gradually getting out of that stage, because at the end of the day, what drives stock prices? It's earnings, right? I think because we've been in this abnormal interest rate cycle, markets are obsessed with the discount rate. So let's be honest. Long duration US tech stocks at 0% discount rate look pretty good, right? That's an infinite value. As rates go up, that's why we had such a difficult 2022, even though these are great companies, growing cloud businesses at 20 or 25%, but the market is really obsessed by that discount rate, right? Because when it moves from 0 to something like 3% or 4%, that has a significant impact on valuations. I think we're in the last innings of this hypersensitivity around interest rates, because normalization is occurring, right? So again, if we had interest rates at a low of, I think the low was 0.75, so 75 basis points is where we got back in 2020, around the US 10-year rate. Now that we're back towards 4%, I think this is sort of the normal range for an economy. If we get a hard landing, clearly, we back down to 3% something, right? But if we stay resilient, I don't see why rates don't live in this 4 to 4.5% range. Maybe the range is 375 on the low side to 475%, 475 on the upside, right? Historically, 10-year interest rates, market interest rates, have been in line with nominal economic growth. So if we have a 2.5% inflation target and 2% real growth, there's no reason we shouldn't have a 4.5% yield on 10 years. Once we digest this normalization, I think it will then increasingly be a focus on earnings. And let's be honest, the market is at all-time highs, and there has not been earnings growth in aggregate on the S&P 500 really for 2 years. Yeah. So all of this, last sort of 10% or more, rally in the S&P has been on valuation expansion. So that's fine. I mean, it is what it is. But I think, I think this obsession with, what are interest rates doing? If the Fed cuts, that's always good for policy. The Fed and other central banks tend to cut when equity valuations are heavily impaired, not when they're at all-time highs, right? So at 20 times plus on the S&P, and I focus on the S&P because it's kind of the lead locomotive in the global train, but also it's the biggest central bank and it's the deepest and biggest equity market. But there are opportunities outside the U.S. U.S. tends to be a big component of our overall equity exposure, so we focus there. But if you look at Canada, Canada's trading pretty cheaply relative to its history, and also relative to the U.S. And also, it tends to shine in late cycle stages where inflation's higher, commodities have a bid, the central bank is tightening. It hasn't really played out this time. But there are opportunities beyond sort of North America. We're seeing some policy tweaks in China. You see the impact of that overnight. That is a coiled spring. I mean, there's definitely a lot of problems in China structurally, but tactically, there's some interesting opportunities if they start to have more panicky responses. The policy in China has been too tight. Let's be clear. So to the extent that they're talking about, home team, $275 billion packages to support equities, you might see some of that quote unquote value realized. So again, it's not all about the US. I think where we would have the most valuation concerns is the US clearly. But it's a great point, Adil. I think at some point, the market focuses on earnings again. And I think earnings will be better this year if we don't have a recession. And then we can start to talk about, okay, what is the outlook for earnings? Is it too high or too low? But interest rates and the discount rate, that valuation factor, I think will become a little less important as we get that normalization. And I'm kind of showing this on this page. Volatility is a measure. It's very skewed. Normally we live at sort of high teens, low 20s in terms of market volatility. You can see we're at 12.5 times now, very, very low. The 10-year yield, as I mentioned, we normally have a 5 to 6% sort of nominal treasury yield, at least historically, the blue period, and it shows where we are today. So this normalization process, I think, is happening. 2s, 10s, obviously, we normally have a positively sloped yield curve, not a negatively sloped yield curve. So I still think that we're in this digestion period of normalization, and that's when the focus will come off interest rates onto these companies that are growing profits, that are taking share from others, that are improving margins, and all of that. As well, you just see inflation and unemployment. So obviously inflation is getting back towards target. I still think we get stuck at sort of 3%, but we're back within the normal range now, thankfully. And we still have a lot of strength in employment. You see that there.
Perfect. No, that's fantastic. You touched on a lot of really good stuff that hopefully we have time to hone in on, whether it's China and earnings and like opportunities outside the US. But I'll maybe try to go one more macro, and then we can hone in on a few of those things, because maybe two parts. We'll talk about sort of everyone has concern over, and then the part that everyone has excited over, right? One of the drivers of last year, I'll start with the positive side of things. What drove markets, or at least a significant piece, is this secular move to AI, right? Like AI is maybe everybody's not using it in their daily life now, but the investment, the billions of dollars. I saw the Apple Vision Pro. I know everyone's seen the goggles come out yet. Like they've sold out, right? Their initial launch, and NVIDIA developing these chips. Like everybody's hearing about this ChatGPT, right? All of these things. So there's you're hearing that AI is the next big opportunity since the internet. And this isn't what they say. It's not crypto. It's not these other things that we haven't found a real use case. These are being used. These are going to change things. And I think that's one of the reasons the market trended higher. Like that, I don't want to call it save the market, but that was a huge piece. And coming into this year, those companies are continuing to drive forward. And maybe they should continue to drive forward, because these are what's changing sort of the game going forward. So on the one side of things, talk to us about how you think about AI, if the hype is real, and is it an important part of the building blocks of the portfolio as you're doing it? And then we go the other way on the geopolitical, because I can't get away from an investor perspective. Look, we hear things like Russia-Ukraine war. We hear things like the Middle East. We hear things like there's, back and forth about shipping, right? There's so much global or geopolitical issue, the elections coming up, which we know in the long run, earnings drive markets. But in the short term, this provides a lot of concern for investors. So how do you navigate the AI on the one side, but then geopolitical issues? You think about China, Taiwan as another one people talk about. How do you have to manage? You're managing portfolios and making real decisions, knowing these things are happening in the background. So how are you thinking about all this?
Sure. I mean, we couldn't have a conference call without talking about AI. It's captured everyone's imagination. I think it is real. It's a different question on, who's benefiting and whether investors can benefit directly. Clearly the only hardware sort of play is NVIDIA with their, with their chips. If everyone's going to try to play this game, they need the hardware to enact it. I think obviously Microsoft also, from a software perspective, they've launched, their pilot. I think it is real. I think it will have a material impact on, the U.S. economy in time. I just wonder if some of these stocks aren't too far ahead of themselves, in the very short term. But I would never suggest that this is, a fad similar to, well, I can't say, I don't know. You mentioned crypto. I mean, we've definitely seen fads over the years that played out and then ended up hurting investors. I still think that investors will benefit. This theme is in its infancy, and it is real. But to your point, I do think it saved the market. in the sense that, there were two things really that saved the market last year. When we saw the balance sheet crisis at regional central banks, and the Fed basically made a facility to allow banks to become solvent, where they weren't. If they mark to market their bond portfolios because of the declines that we saw in 2022, they weren't solvent. So effectively, that injection of liquidity on top of the AI theme made up for the fact that, again, there was really nothing exciting in aggregate for the U.S. stock market. There was no earnings growth. So really, that is what boosted valuations. Now, it's silly to ignore the impact of inflation. Clearly, inflation, was falling, and that's a very good thing because of the Fed, was definitely towards the end of their interest rate hikes. But I would, to your point, I would talk about AI and that liquidity injection that saved the regional banks as being really pivotal in driving that positive narrative for U.S. stocks, and the exceptionalism that came from the U.S. Let's face it, if you buy into that theme, there aren't many companies. Yes, there's TSMC, and we're well exposed there. There's ASML in the Netherlands. But generally speaking, you're talking about U.S. exposure to this theme is most significant. And I think in part, this is what underlines the sort of the bifurcation in equity markets. You have one market that's very expensive. Some may argue that it's not as expensive as you think because there's going to be earnings delivery in a lot of these areas, but you can't deny that versus its own history, the U.S. is expensive, and every other market is cheap. Now, Japan, interestingly, was the best market in local terms last year, and it's no longer cheap, but it's only fair value. The U.S. is actually very expensive when you look at price to earnings or EV/EBITDA, but it has some fundamental underpinnings like Nvidia's and Microsoft that other markets don't have. So in some cases, it is justified. On the geopolitical side, I would really point to that being one of the key theses that we have around inflation getting stuck higher, right? So we've all celebrated and taken multiples and had a big, taken multiples higher in equities, taken bond yields lower because we're celebrating this decline in inflation. I think that's all correct. We went from 9-10% year-on-year inflation down to 3-4%. But that was always going to happen because of base effects, and it was always going to happen because of that surge in excess demand for goods. When people couldn't get enough goods, prices went up a lot. And then the natural, recession that we've had in goods and in manufacturing. Importantly, I'm not saying the overall U.S. economy, but yes, in goods, we've been in recession, i.e. the ISM's been below 50 for over a year. It's been the services side of the economy again, and inflation that's kind of kept things moving higher. I would say that all the geopolitical tensions, all of the dismantling of supply chains, whether it comes to China, whether it becomes, we all remember the decade of just-in-time inventory that made things so much more efficient. Comparative advantage, you go and get source your inputs for your products or services from the cheapest, best supplier out there. Well, that's no longer the priority. It's more about, just in case instead of just in time. I think all of that builds in a little bit more cost structurally, which suggests that it's probably too early to celebrate inflation getting to target, i.e., that goes back to our view that probably 7 rate cuts, we would say rate cuts, yes, but not to that extent, because inflation won't behave and get to 2%. Now, I'll tell you, if it gets to 2%, it's probably because we have a hard landing. But in absence of a hard landing, I think inflation is sticky here, and the Fed and other central banks may not be able to cut quite as aggressively as the market is sort of discounting. And I think a lot of that does tie to these geopolitics, right? The CHIPS Act is wonderful. It's going to take these foundries 5 to 10 years to get on board, and they're going to be more expensive than they're being made overseas. Like we are locking in higher input costs, higher supply chain costs wherever you look. Not to mention, I didn't even mention sort of the crisis in the Red Sea now. I mean, we're seeing 40% of global shipping diverted from the Red Sea, adding 2 weeks to travel times for container ships and for valuable commodities and goods. So, I mean, I don't know if it happens in the next report, but I think, by the spring, we'll be talking about, maybe the Fed can't cut as aggressively because we're still growing at trend. We're still growing 2.5% on the U.S. economy, which is arguably above trend growth, and we're still not seeing 2% inflation. I think that could, cause a bit of a realization that, we maybe can't cut 7 times. And I think, geopolitics is just one part of why inflation stays higher, which means, volatility is likely to increase this year. As I showed, the VIX is at really all-time lows. And when volatility goes up, risk assets tend to trade a little bit more defensively.
Yeah, that makes a lot of sense. So then switching from macro, because we can forecast and try to figure out how do we position portfolios, but just going into the portfolio for a minute, and specifically to talk about bonds. There's so much talk about, and then we could talk about positioning, but specifically when we talk about bonds first, there's just so much talk about, I mean, we understand equity markets. We kind of understand you invest in a company earns more, we get a share of that, it goes up. Bonds, we know it's just, even though we know it's a very important part of a portfolio, it's just less talked about. And we know in 2022, everything went down. So you're building multi-asset class portfolios. So everyone listening, the idea is that, as some things go down, others go up. That's the idea of having this inverse correlation, this offsetting return exposure. But in 2022, everything goes down. And then for the last 10 years, we've had interest rates at 0. So you heard bonds are dead. Bonds don't do anything. And then in 2022, every headline was the 60-40, the 60% equities, 40% bond portfolio is dead because they don't work like an inverse correlation. Now bonds and interest rates are at 4 and 5%. Clients everywhere are seeing you can get a GIC, you can get a bond, and we can have the argument of a GIC over the conversation of a GIC versus bonds, but just take us through, are bonds back? Is this a real thing? Are we going to get real value now? And is the inverse correlation back where it's an important part of a portfolio and we should care about it now?
Great and central question. Appreciate it. I think, again, we can pick up on the theme of inflation. So historically, when you look at bond stock correlation, it really breaks down, i.e., you lose that diversification benefit because both stock and bond prices become correlated in periods of higher inflation. So that's exactly the playbook that happened in 2022. Stocks went down, but really the problem was bond valuations, negative real interest rates, right? You had inflation running, as I said, peaked at 7-8%, but for 2 years it was running 5-6%. And bond yields were anchored at 1 to 2%. The negative real rates of return couldn't be sustained. So, the reason, bonds were the problem. So in that case, they both fell. So now that inflation is a little bit more anchored, let's say, I still think it's on the high side. So I don't think those correlations revert to when, we had 0, very, very low inflation or disinflation and low interest rates. Then you really saw that negative correlation feature. I think it would be somewhere in between. I think you still need to be thoughtful. So bonds are back, point number 1. I will agree with that. We were basically max underweight fixed income because we felt that was the worst place to be, and eventually there would be a reset now that inflation was back, and rates would have to go up, and obviously that proved to be correct. But we're not market weight. We're still underweight fixed income, so we're finding better value for that 40%. So we've definitely taken weightings up, and we've added a lot to fixed income over the last quarter, but still remain underweight. I think that 40% needs to be, so that if you think of that 40% of portfolio, it needs to be more thoughtful than it has been in the past. So, in the past, maybe you just buy treasuries and that's your 40%, right? Because that really is historically one of the best hedges to the equity market, because you got, US dollar exposure on the FX side, and that, tends to be one of the best currencies in a risk-off scenario, on top of the most liquid and deepest U.S. Government bond market. But I wouldn't say that that's the playbook anymore. If you look at, and this is going to shock you, but if you look at emerging market bonds, so you look at Chinese government bonds, has outperformed treasuries by 30 to 40% over the last 3 years. And not just the US, you had it outperforming European government's bonds, German government bonds, Italian bonds. And part of the reason was, a lot of these, a lot of these emerging markets had more orthodox monetary policy. And what do I mean by that? Historically, they've never used things like QE, right? They've never done these bond buying programs that are fairly commonplace now in Western central banks like the Fed, like the ECB, like even the Bank of Canada. So those more orthodox, so they really just control monetary policy and their inflation and growth through, target interest rates, right? They, the old-fashioned way. So I think that focus on doing things more orthodox and not, having to do QE and some of these other things made them a much better store of value as, the bond market got silly and began to offer negative 3, 4, 5% real rates to investors. So I know it's a real long question, but you need to be thoughtful to that 40%. It's not just treasuries anymore. It's treasuries, yes. It's Government of Canada's, yes. It may be some EM fixed income. It's probably also, shorter duration securities, cash. You talked about the overnight rates being 5.5%. I mean, cash at times can be a real asset class, right? So if you can earn 5.5% and you're unsure of the correlation benefit of holding bonds, and yields are actually less than that if you're holding bonds, and you're not sure that they're going to, be negatively correlated to your equity portfolio, I think cash is a real asset in the current environment. You don't want to overdo it because obviously, 5%, you're not benefiting if rates go lower, but that's 5%. So I think you just, bonds are back, but I'd like a more holistic way to think about that defensive side of the portfolio. It would also include things like gold. It would also include things like defensive currencies, and so on and so forth. So I'll say we've definitely not just put a toe back in the water. We've waded back in to these improved bond valuations, but I don't think it's the time to get maximum defensive in portfolios or maximum aggressive on bonds, because as I mentioned at the outset, the odds of recession are certainly lower, right? The odds of no landing have gone up. The odds of a soft landing have gone up. So we need to think about how interest rates, market interest rates, that is, stay higher for longer. And that's kind of our central view.
Yeah, that makes sense. So it sounds like bonds are back. It's just you have to be a little bit more tactical, a little bit more diversified on that 40% than before when it was just one thing. But I think it's safe to say that the 40%, I don't want to say that did nothing before, is doing something, is actually doing something for you now, which is important. Which I think is, especially after 2022, when everyone didn't like bonds and then they get crushed, everyone then, emotions say, stay away from that going forward. And that's usually the time that it's the opposite, right? So
Dale, can I just say one thing? Sorry to cut you off, but
no problem.
Just to highlight return opportunities. So, we have an exercise at the start of every year. We look at sort of top-down index targets. Our target really for the US is not much more from where we are here. If you look at, projecting what our earnings outlook is for the S&P and where we think valuations should be in this macro environment, we're getting to around 5,000. So when you think about our upside target, it's probably less than cash or even equivalent to cash. So risk adjusted, if we're right on the stock return, why would you take on that kind of volatility in portfolio when you can earn a 5% return? Now, we may be wrong. Obviously valuations could expand. We might get better earnings growth than we suspect, but you're certainly not talking about a year like 2023 where you had 20% plus returns. I would think it's more like single digits, maybe mid-single digits, maybe even a flat return year on year, which then looks very compelling to some of the risk-free assets that you're getting now that rates have gone up. So just to put it in perspective for investors, why we're not piling into the equity market when we can offer similar returns. Now, outside the US, I think you can, potentially get to double digits if we get no landing, because you have both earnings growth and valuation expansion potential possible, unlike the US market.
Yeah, I think I'm glad you jumped in. I think that's so important what you've said there, because we may see our return numbers on our statement. And I think investors, clients, listeners need to know that when you're building portfolios, it's risk adjusted returns. It's what's the return I can get for a given level of risk, right? So I could get, if I got 15 in equity markets, what type of level of risk did I have to take to get that? Versus, if you're saying an equity market is, what is the differential that you could get from an equity market versus a fixed income? I won't say guaranteed return, but something that is a little bit more fixed, but you can take much less risk. We have to think about, which we don't a lot, is what is the risk it takes to get that versus just seeing the number. So yeah, very important. So with that, because you're on that, let's talk about, you've named a few things in terms of portfolio positioning. You talked about opportunities outside the US. You've talked about, Japan. You've talked about, weights and bonds. So you talked about geopolitical issues, like all of these different, we may be, risk of a recession. So how are you actually, when you actually have to place the buys and sells, allocate the portfolio, how are you allocating it based off all this? What are you over and under? What are you feeling more conviction and lower conviction about?
Okay, great. Thanks for that. And I've just highlighted a slide to help guide me. I think diversification is key. Obviously, we're not, betting on one individual asset. We have a multitude of assets, because even within equities, you can have, less than one correlation. Obviously, what's driving the U.S. market is very unique to the U.S. market. No one's buying Canadian stocks for an AI play, let's just say. So, diversification within equities, we certainly have a lot of that. Effectively, we're, around a third on our equity exposure in the 60/40 portfolio, and this would be similar across all of the risk profiles for all of the clients that are on the line. But incrementally, we're seeing more opportunities in markets like Japan. As I said, Japan's been one of the best markets this year. Really, that was driven by a policy that continued to be tight. They have not raised interest rates. Their inflation was not the problem that it was in most of the Western world. So policymakers were able to keep that overnight rate anchored and yield curve control in place. So effectively, while the rest of the world was tightening, you had the Bank of Japan that was continuing to be very easy. That led to a weaker yen, which led to hyper competitiveness among Japanese companies that are world beaters in a lot of different areas, like industrials, autos, consumer goods, things like that. So and you had a cheap market. So really, Japan has been, one of the best stories this year that's kind of gone unknown because it's not tied to AI. But we have, that valuation gap has closed, so it's back more to his historical sort of rate of valuation. So we have taken down that view a little bit. We continue to be wrong and early. I'd rather say early than wrong. Emerging markets are something that we still think makes sense in portfolios. And actually, if you exclude China, EMs have been doing fine. India is on fire. Brazil has had a tremendous year. There's a lot of markets in EM that don't start with China that have actually quietly done very well here. Overnight, it is interesting. It's just one data point, but I think if you look at the Chinese equity market, clearly it isn't a buy and hold. It's got some structural problems. But tactically, if policymakers, have to panic because the market is hitting new lows or they don't like the growth profile, and I think they are starting to get a little bit panicked. They're a little bit cornered. I think they have to do something meaningful to spark some interest again in Japanese stocks. In Chinese stocks. We don't necessarily buy just because of the technicals, but look, if the valuation is there and we think, it should trade cheap to the US, it is not a pure capitalist system, but it's a matter of what is that discount. Right now, it's at 50%, right? So we're thinking that, a lot of the valuations in Chinese equities are taking on board a lot of the bad news of their structural story, the fact that they're, you know, some people call it anti-capitalism because they'll take out certain sectors like education like they did in the past. All of that is true. I just think that's reflected in stock valuations. So to the extent that you see, you know, them, you know, bring forth maybe a package of 300 billion to support, you know, the domestic market, that might be enough to trigger some kind of a tactical rally. So we're sort of, you know, we're overweight all emerging markets fairly equally, because again, you have really compelling valuations. You don't have as tight a policy as you have in Western markets. I think a lot of that is clouded by what's going on in China right now. But again, if you look ex-China, which is the majority of emerging markets, China is a big chunk, but it's still only 35% of that emerging market equity basket. There's a lot of good things going on. I mean, if you just look at Latin America, again, maybe not enough to move the needle, but you have, you know, the new prime minister or president of Argentina, who's just throwing out the rule book, right, and bringing back a very right-wing agenda, you know, firing all of, you know, 5,000 government officials, consolidated, I saw, you know, 18 departments to 9. It's going to privatize a bunch of these public companies. Like, you could just say, oh, there goes Argentina again. But I mean, if it's kind of a litmus test for what's going on in the region, and that shifts to more, you know, capitalist-friendly policies, you know, you could see that giant discount that is on Latin American stocks sort of come out, and you know, see a re-rating as people look for better opportunities. Like at the end of the day, you know, if you're a big institutional investor, if you're a retail investor, but especially if you're an institutional investor, you know that you have more opportunities in fixed income, you've reallocated, but you still need to manage the equity book of the portfolio. And, you know, to be honest, to buy, you know, the S&P at the top percentile in terms of valuation, you want some other ideas to diversify that portfolio. You're going to have US equity exposure and have the AI themes in there. But there are some real opportunities to diversify that equity book that are beginning to have some really interesting stories. And so I think emerging markets, as much as it hasn't worked last year, you know, I still think that you need to hold it for that asymmetric return potential if you get a few things going right on the policy side.
Yeah, that's perfect. Because that's interesting because, you know, you've answered one of my questions about China. Everything you read is just population growth is going down, property sector issues, isn't getting the growth from COVID. I think they're trading at like year lows, right? But when you look at it from a portfolio manager perspective, it's what is the valuation? Like, is that built into the price, right? We only just see the negative headlines and go, oh, we got to get away from there, right? So you're more constructive on that, which is interesting. So fantastic. Just being cognizant of people's time, I'm looking at the last. I mean, I could talk forever. Small cap, large cap, Magnificent Seven, you know. But why don't we sort of end, because I feel that with two pieces. One is the U.S. elections coming up, right? And I feel like it's just, I mean, it's a circus. It's not going to hit all the headlines. Everybody's sort of who's interested keeps their eye on it, like I do. So. And we know, I mean, the data is out there that over the long term, Democrat, Republican does not play a material role on what's happening in markets. But maybe humor us in terms of just how are you thinking about if that matters, or maybe it just matters because of the volatility around it. And really, markets just want certainty when it's over and they know what side it's on. But how do you think about the US election? Because I just think that's on everyone's mind. And then the final piece is there anything, you know, I didn't ask her that you would want to leave us with, or how you're feeling going forward, or anything that you think it would just be important for us to know?
Sure. Okay. Yeah. In terms of U.S. elections, I mean, I think you're already starting to see after the Trump win last night in New Hampshire, he's now taken 2 of the states. I mean, it looks very likely like he is the nominee. If he runs against Biden, I think most odds makers would put a Trump presidency in 2020 into 2025, which we all may have different opinions on, but as you say, it's the certainty, and once that certainty sort of comes into view, maybe markets, act a little bit, they settle down. But the one thing I'll say is that I think the wild card here is I'm not convinced, and I think the Democrats are playing their cards close to their chest. I think they know that they don't win in a Biden versus Trump election. You need a lot of things to go right. I don't know how we get a reacceleration in the U.S. economy from here. Maybe you get more interest rate hikes induced than otherwise you would expect. So that keeps the party going, longer. But I do suspect that growth will slow a little bit, even with rate cuts. But I don't know how Biden, my own personal view of looking at the polls, I don't know how he doesn't poll well against Trump. So the big wild card, I think, for elections this year is do they replace Biden as a candidate? Now, I think they want, Trump to be the nominee to be settled before they do anything like that. But I think, and I don't know who the candidate is, there's a few alternatives, but there are non-Biden tickets that actually poll better against Trump than a Biden-Trump fight. So I think I think markets will start to discount a Trump fight unless there's a change on the Democratic side in terms of who their nominee. They could do it very gracefully around, the health of Biden, or, it doesn't have to be that, we're losing and we need to change the face of this election. But I think that's one wild card that, I don't know what the probabilities are, but not many people are talking about it. And I think it actually is a possibility now that we see that Trump is likely to take the nomination. I don't know how Nikki Haley, I mean, she carries the next primaries in her home state of South Carolina. So maybe that's a reprieve for her, but I just don't see the way it's going that it isn't a Trump nomination. So that at least gives certainty on who the nomination is. And as I said, any head-to-head poll, Trump is winning, every time. Yeah. So that's kind of it. Now, we talked about certainty, I guess, of a candidate. I think Trump continues to have an isolationist view, i.e. this world from sort of the Davos crowd, multipolarity or from a unipolarity to, a big, happy, capitalist global family to more regional spheres of influence is likely to play out more significantly under a Trump presidency. So these things around dismantling supply chains, growing geopolitical tensions around, Saudi Arabia and the Middle East being under the sphere more of China and Russia than it was formerly under Europe. Asia, obviously, sort of splintering as well. I think that ratchets up tensions for, concerns around, things like what happens in the Ukraine or Taiwan, or more hot wars in the Middle East as a result of what's going on. So I think, unfortunately, Trump fans the flames of those, emerging geopolitical tensions or coals, so to speak, to stick with the analogy. And I think that gets diffused under anybody that's, a Democrat from that perspective. So there may be more certainty on the Republican nomination, but if it's a Trump presidency, I think that you could see some more volatility just in light of some of those, those geopolitical tensions being sort of, amped up.
Yeah. Perfect. Yeah, I agree. Trump, the only predictable thing about him is the unpredictability, right? So so maybe just it kind of answers all of the various questions. Maybe just anything you want to leave us with in terms of, or I didn't ask, or just kind of how you're kind of moving forward for the remainder of the year. Any final comments, basically?
Yeah, I think we, I would say that we're looking for sort of asymmetric trades, and I mentioned the emerging markets one. We're also looking at low volatility, which as an investment style has not worked. It doesn't work. We don't really have significant positions in the portfolios, but we're looking for those asymmetric payoffs. So we might get another year like 2023 in the sense of directionally the Magnificent Seven continue to expand. And I don't call it a valuation bubble. Like if you look at something like Nvidia, they have delivered on the fundamental side. So their valuation's actually gotten cheaper because they just doubled, and tripled revenue and earnings per share. So there are some select unique stories within the US, but also globally. I think the one thing about higher interest rates and eventually more economic volatility is more financial market volatility, which should favor low volatility as an investment style, is trading at an enormously discounted risk premium, similar for value. But I think idiosyncratic risk is back, and we definitely saw that in 2023. So a continuation of that this year would be good for portfolios because these APP portfolios do have underlying stock and bond pickers that don't look like the benchmark. So they do take active risk. They do significantly overweight semiconductors, and which is the case in a lot of our underlying mandates. Again, that's not our call. We kind of hand off to the micro expert at that point. Going back to the levers that we control, asset allocation and sub-asset allocation is us, but really when it comes down to Nvidia versus AMD or how much in semis versus software, most of that is really delegated to the underlying stock pickers and bond pickers, as the case may be. And we're in good shape there. I think those managers have a good opportunity set in the environment we're going into. So while asset allocation may not be aggressive this year, I think there's still a lot of active management that's going on that can make this another strong year for the portfolio. And if not a slightly less strong year for markets overall. Again, I'm not going to give you an exact point, but I don't see why bonds can't earn coupon this year because interest rates don't have to go up a lot higher. If we stay out of recession, that's 4, 5, 6% in the case of credit. I don't see why in aggregate equity markets can't do high single digits, which brings us to a lower return maybe than we got last year, which was closer to 10% for a balanced portfolio. But, it doesn't have to be a negative year like 2022. So maybe I'll leave it at that. Thank you very much for the opportunity.
Yeah, no, I really appreciate it. This was fantastic. We're definitely going to have you again. I think it sounds like you're constructive. It sounds like regardless of the environment, I think from an investor standpoint, there's always going to be risks, but there are opportunity, there's positioning. We have to continue to position portfolios. And it sounds like there are parts of the portfolio that are going to be working, and that's what we want, right? So thanks, everybody. Thanks, Steve. Thanks, all the listeners. Thanks, everybody who tuned in. If you have any questions that I know we kind of filled the hour, send it to me, Andrew, Jillian. We'll get it to Steve. We'll get answers. Send us a note. If there's anything you want to see in the future, Steve again or others, let us know. But enjoy the rest of the day. Stay warm, and thanks again. Cheers.
Thank you.